Thanks for joining us on Squawk. I'm Bruce Whitfield. You're watching CNBC Africa, first in business worldwide. As usual, we start the show with the latest financial news, market stories, and to guide us through what has been a fairly dull week from corporate information perspective, David Shapiro from Sasfin and Mike Horwath from Applied Capital Insights. I say fairly dull, but there is a tsunami of tsunamis building. And I think you described it to me earlier, Mike, as this is almost the backward tsunami. Japan got hit by a tsunami 18 months ago, and they're sending it straight back into the ocean. Currency wars. What's going on?
Well, liquidity coming in, liquidity going out. And I think, I think the international markets are beginning to sense just how big this thing is. And of course,
what is this thing?
This thing is the kind of monetary liquidity and stimulus that's been provided into the system to actually fundamentally push down the yields and make it so unattractive that a lot of the Japanese investors are now moving out of the country and looking for carry. Of course, we've got one of the highest deposit rates in the world, so of course we're a classic kind of target. Now, it doesn't take a lot to actually start to move our currency.
No.
So, we've been having bond inflows, etc., and this is just going to add more fuel to the fire. So the real big question, and it comes back to the resources, the real big question here, if you've got commodity prices that are starting to soften, and you've got a rand that decides, or because of the capital inflows, actually now starts wandering towards 8, and you've got all the problems you've got from a cost point of view, this could not be a particularly good situation for resources. So the rand is the wild card here.
Do you buy the run towards 8 rand to the dollar, David Shapiro?
Maybe not 8, but I think that if the flows do start coming, it could get us back to 8.50, thereabouts. Maybe a little stronger once it starts. And people forget very quickly the worries about South Africa's current account deficit, the powers, the strikes.
None of that matters anymore,
because you're sitting on a desk at UBS in London or at Merrill Lynch or one of these places there, and you've got all this money available. You look for a home, and you look at South Africa, 5, 6, we're 7% dividend. Interest rate yields now, the money comes. The danger, big danger, read Christine Lagarde this morning, 3-speed economy.
Explain?
There are nations that are growing, there are nations that are coming, starting to pick up again, and there are also the emerging markets. The worry is the emerging markets, because this money comes into emerging markets that are growing. It's cheap money now, later it becomes expensive. So these emerging markets who are growing start to overborrow. That she sees as a big danger.
Okay.
So it's a concern, because if we can get hold of this cheap money, we're just going to take as much of it as we can. Who knows where this goes down the line? That's the warning sign. But listen, that's next week's We're rejoicing. We're rejoicing in the meantime.
We need a stronger rand. For whatever is driving the rand, we've got some really, really weak fundamentals. We need the rand to be stronger for a range of issues. Most notably, for most poor South Africans who probably don't appreciate the importance of this, inflation.
Number one, we import virtually everything that we consume.
Yeah.
If you had to go around the studio, I don't think you'd find one item other than us that were manufactured in South Africa. I think everything else is imported. We export, and we're actually a big trading nation. So we export a lot, and we use that money to buy imports. The problem is that we're importing more than we're exporting.
Correct, absolutely right. So you're forecasting 8 to the dollar by when?
Well, let me put a caveat on that. I'm saying that there's a real possibility that the rand could strengthen much more than anyone expects, and
closer to 8, not necessarily to 8,
and closer to 8 than to 10.
Okay.
And I think part of the problem here is that if you look at the trade account, we've got a mining surplus which is now becoming more and more unpredictable. That is partly offsetting big manufacturing and capital equipment deficits. Now, the capital equipment deficits are very lumpy because a lot of the machinery that's coming in is big stuff. So how in the world do you actually forecast the rand on a monthly basis? I wouldn't have the faintest idea, because it's really the interplay of the capital flows that are coming in and this trade deficit. So it depends what's actually happening at the time. So you can go, I reckon you could go from 850 to 950 in a week or 2 weeks. We're into a much more volatile environment, I think.
That's the point I was hoping you would make, that volatility, which is so destructive to every level of confidence, whether you're trying to invest, whether you're trying to buy capital equipment, whether you're trying to export. I mean, people are going to have to take some very courageous positions when it comes to.
We're investors,
to the
that's
currencies.
easy.
Yeah.
You know, we're investors are easy because you can press a button in and out. But if you've got to buy one of those lumpy machines, you've got to make the decision. And if you buy it at 9.30 and you buy it at 8.70, it makes a huge difference to the cost of the goods that you produce. So volatility can happen. Now, the other thing that's happening, have a look at what this is going to do for markets. It's very good for markets. Last night we hit an all-time high in US markets. We just sailed up to all-time highs. We all follow in the UK and so on. So what happened now? Equities become the game, the money starts to flow here again, and we start to see our retailers pick up again. Everything that we had knocked down will start to pick up.
Isn't it extraordinary? Mr. Price's trading update, the story told one part of a tale, and Pick and Pay told another part of a tale. So let's look at that in some detail, because suddenly retailers, which have been well and deservedly bludgeoned, have started bouncing back, and Mr. Price just keeps revisiting why it is that it is so loved as an investment.
But have a look at it. It's a very good story, that. But if you break it up into two parts, because they only gave us a trading update, they were up like 35% in the first half. So it means the second half there was a slowdown. Yeah. Why did it respond is that early in January, I think they gave us some kind of indication of what happened over the holiday season, which was very poor. And the markets reacted and started to discount the share. Suddenly we get 20%. And it's not so bad. So that's why we got the reaction. But there's also money flowing in. The one, if I can just break for it, but the one that we've ignored was Massmart. Yes. Massmart hit an all-time high.
Did it hit 200 yet?
Yeah, it's over 200.
Over 200. Pooh. I missed that one.
We all missed it. We all missed it slowly while we've been focusing on others. Here's this company that's just gone up to an all-time high.
Grant Patterson's planning his retirement at age 45 or thereabouts.
So the money's flowing back in. You know, we're starting to see it trickle back into equities as well as bonds.
Okay, so there's the good news story. Okay, so there's good stuff happening for Massmart. There's good stuff happening for Mr. Price. We saw Foschini Group and Truworths rise alongside of Mr. Price. And then you've got Pick and Pray.
But Bruce, I think it's really important to understand that this slowdown, there's no question the consumer's slowing down.
Well, consumer confidence at a 9-year low, business confidence at a 13-year low. Consumers are feeling
debt levels starting to rise again.
Yeah.
But what's really important to discern is that this slowdown is uneven. The top end of the market are much more resilient than the bottom end for the inflation reasons and the job loss reasons that we were talking about a little bit earlier. The lower income groups are having a really tough time now, which is why I think people are getting a little twitchy about the unsecured lending side of things, and particularly if government slows down on its employment drive, which hopefully it's going to. These all spell a much tougher environment for the lower income group spending area, whereas the higher income groups, the Woolies and that kind of part of it's powering along. You've still got this, although I noticed AdCorp's latest figures showed some of the skilled jobs were actually being lost, but you had this tremendous surge up the LSM distribution, life living standards measure distribution in terms of incomes, and that's been powering up. I mean, you've got to say, where does all this money, all this corruption money everyone talks about? It's all
it's got to be spent somewhere
around in the economy.
Oh, so it's a good thing.
And it's at the top end of the market. So, and it seems to be staying in the economy. So the fact of the matter is, there are a couple of components which are non-traditional, which are actually holding the show together. So I think you've got to be very discerning about where you're pitching yourself.
That's the best justification I've ever had for corruption ever. Oh no, it's really good for the economy. Okay.
Well, at least it's been channeled back into the economy.
Well, if it was moving out of the economy, we would see it, and we wouldn't be seeing the top end of the market flying like it is.
Bruce, there's another element as well. You know, if you go to Sandton City, I don't know if it's relevant or not, or whether it makes a difference. You go to Sandton City and you walk around there. There's a huge amount of Africa shopping in South Africa. Stores like AVI, which is A&D Spitz, Kurt Geiger, high quality stores.
It's where you
doing
buy your
very,
shoes,
very
isn't it?
Mine.
And they're not coming to buy mealie.
No, and it's cash.
Yeah.
It's also cash in that. So the elements, I agree with Mike, that are.
Let's talk about Pick and Pay, please,
yes.
because the trading update that came out of Pick and Pay, Mark Whitten from Kaizen shorted it on a recent issue of Share Shootout. I'm just saying it is structurally deficient. It is a diabolical mess. Richard Brasher has probably taken on a business he never knew how deep-seated and deep-rooted the problems were.
I think it's going to take them a long time to turn it around. You don't turn around businesses that have fallen off the cliff. You don't climb up that fast. It takes a long time, and particularly your competitors are not just opening up for you. They're going to be aware of you trying to climb back. You're weak. They're going to keep hammering you. So I think that Pick and Pay will start to improve as structurally they're in a better shape. They start to distribute from the distribution centers and so on. All of this that we've been waiting for, but don't think it's going to be easy. I don't think I'd short it. But I don't think I'd buy it. In other words, I think we're just going to amble along. I don't think we'll fall down, but we'll just amble along at a much lower pace than the competitors.
Dare you go long on Pick and Pay?
No, I wouldn't go long on Pick and Pay. Again, I think trying to turn a business around that actually has quite some real problems from a consumer perception point of view. On top of all of the restructuring it's done in terms of its DCs, etc. And I don't think the likes of Massmart and all the other competition are going to give them 1 inch of space.
Absolutely not.
So when we aren't generating the cash flows, like Mark was saying, that really is a problem. I mean, you're fighting a real uphill battle. So I guess you just look at who do you think's actually winning the battle. Just look at the share prices.
Yeah.
Massmart's at an all-time high, and Pick and Pay is not.
No, absolutely right. So yeah, it was a disappointing trading update that came out of them. Also, Telkom with a disappointing trading update. But if a Telkom trading update is not disappointing, well then that would be disappointing. We're just so used to turgid bad news. You made a great analogy this week, David. I was chatting to you earlier on this week. You were saying, no, Telkom's the same size as JD Group.
Exactly.
And JD Group isn't exactly the superhero.
It's the worst of the
retail.
retailers. Yeah, exactly right. JD Group is a $7.5 billion company. It's been under severe pressure. Telkom $7.5 billion. If you took all that copper out the ground and sold it, I'm sure you get 4 to 5 times the value of the share.
People keep trying to do that.
I know. Maybe that's what. But if this business just got back to what it should do and say we're going to focus on fixed line. I know it's a dying industry, but just focus on it. Do it properly with a little bit of ADSL or 1 or 2 other products.
Put a pipe that big into my house and bring me Apple TV, and you've got a customer.
Absolutely right. Instead, they keep going in all kinds of direction, trying to keep up with the competition. And it's going to be hard for them to do so because they're going to have to lay off a lot of people. They're going to upskill a lot of people as well.
A positive investment story. Tsoho-san, 750 million rand in casinos. That's a big bet.
It's certainly been generating the cash flows.
Yeah.
So to me it makes sense. I think it's quite a good idea for them to do
these
that.
dank, sprawling pits of sin.
I think consumer spending.
It's not my favorite area of business. I've never been to a casino. I always say that being on the stock market, 12 hours a day, you've got enough volatility to keep you occupied. You don't have to go try your luck on a what's it, a poker machine? What do you call those? One-arm bandits. And I think you press the buttons now. But they're adding a lot
about something he's never been to.
But Monte Casino is now, is an attraction. It's an entertainment center, and they're doing the same thing. What's the one?
Well, compared to the rest of Four Ways, Monte Casino is incredibly attractive.
Yeah.
Oh dear, we're going to be in trouble. More with Mike Hawes from Applied Capital Insights and David Shapiro from Sasfin in just a moment. Sorry, Four Ways, it was a joke.